Hey, Renter Retires. It's Adam Schroeder here with another episode of our podcast. And today I'm joined once again by the Renter Retirement CEO and founder, Zach Lemaster. And we have a special guest with us today, Dave Foster. He is the 1031 specialist and qualified intermediary and founder of the 1031 Investor. Dave, thanks for joining us today.
Well, how could I complain about being in such esteemed company? It's great to be here with you guys.
I'll take your word for that. So we wanted to start off. We haven't done an episode on, I believe, about 1031s yet. So why don't we start with what a 1031 isn't and what it is? Because a lot of people, they hear 1031 exchange and they think, oh, I don't have to pay taxes. Well, that doesn't mean you're never going to have to pay taxes, or there doesn't mean you can't mess it up and have to pay taxes. So what is a 1031 and what isn't a 1031?
Oh, that's awesome. That's a great question, actually. So I guess start off what a 1031 isn't. It's not a loophole. It's not a dodge. It's not one of those things that Wesley Snipes used to go to prison with. 1031 has been part of the tax code since 1920. So it's actually 100 years old. Now, over the last 30 years, there were a couple major court cases that, surprise, surprise, were won by the taxpayer in favor of them over the IRS. And so that changed the whole scope of how these things were designed to be used. And now they're available just for normal investors like you and I. And what the 1031 started out to be was an opportunity for farmers who had lots of land but no cash. And in order to help them, as we were leaving the agricultural age, entering the industrial age, it was an opportunity to let those farmers sell their farms to buy bigger farms and not have to pay tax on their sale. Because in so many cases, if they had to do that, they wouldn't have any cash left over to go buy the new property. So that was the whole premise of the thing. Sell real estate. And by buying new real estate, you don't have to pay tax on the profits from your sale. That's what a 1031 exchange is. It's not a loophole. It's actually what one of my mentors likes to call an incentive. He said, Dave, don't think of the tax code as a way that they use to make money. That's just part of it. The tax code is really the way the government incentivizes behavior. And when you do the behavior that they want you to do, you're rewarded. In this case, what the IRS, what the government wants to see is a robust, active real estate market. And to do that, they incentivize you that if you sell investment property and use the process called a 1031, you get to indefinitely, Adam, because I'm not going to let you get away with saying you got to pay one day. You get to indefinitely defer paying the tax that you normally would have on the profit and on depreciation.
I love that. That's so crucial, Dave, that you gave us a little bit of history. Thank you for going through that so we can all kind of understand that, hey, yeah, this has been around over 100 years at this point. Likely not going away. Everyone's concerned about legislative changes. That's always going to be the case. But this is probably something that's here to stay. It might change, certain parameters from time to time, but this is something that's well ingrained in the tax code. And to your point, being offered as an incentive to go out and create economic stimulus. This is an economic benefit to the country as a whole for investors to be active and trading properties. And so I think because of that aspect, it's here to stay. And we'll talk a little bit about your opinion on recent legislation. But before we get too deep into that, maybe we can just start by using a simple example so everyone can understand, if they're not familiar with the 1031, what it is and how it works. We can just go through kind of a basic example. And don't let me forget about the indefinite part, because that's also something we want to talk about is, okay, what happens when your time on this earth is done and you're passing on, real estate to heirs? Is it forgiven? I mean, maybe let's start with that real quick and then we can go through an example if you don't mind.
Okay. Yeah, absolutely. Because that'll lead into it really well. So this is what I call the 4 Ds of 1031 investing. And they are, everybody get your pens ready. The first D is defer. Because anytime you sell piece of investment real estate and use the proceeds to go buy new investment real estate. By the way, there's also another section of the code that deals with your primary residence. Anytime you sell a house that you have lived in for 2 out of the previous 5 years, you get to take the first 250,000 or 500,000 if you're married in profit tax free. So between those two parts of the code, anytime you sell real estate, buy real estate, you'll at least get to continue to defer tax on the profit. Second D, defer. Because you just keep rolling forward. There's no limit on the number of 1031s that you do. There's no limit on the type of property. There's no limit on the location of the property within the United States. So one of those just quintessential examples are one of those crazy Californians that have seen their property go up 500,000% in the last 10 years. They can sell that and go buy single family homes in Southwest Florida, or some multifamily properties in Kansas, or duplexes in Ohio, wherever their journey needs to take them, and continue to defer the tax. And the import of that is really just a form of compound interest. Because as long as that tax is deferred, I'm making money on that, and then I'm making money on the money that I made on that, and it just keeps rolling forward. So the longer you can defer, the better off you are. Guess what the third D is?
I'm guessing defer.
Bingo. Yeah.
I'm ace in this class.
You're an A student. Because ultimately you can shape your portfolio towards your retirement. You could end up ahead of retiring to Florida by moving all your rentals to Sarasota, where you want to retire, and end up retiring with all your rental portfolio right beside you. Zach, I know you guys are doing a lot of work down in Southwest Florida, Cape Coral. Mm-hmm. You may end up buying several rental properties down there and then moving into one of your new builds down there. And you'll never pay the tax. You can convert a property from investment into your primary residence. And again, continue to defer the tax, because as long as you don't sell it, the tax stays deferred. Adam, guess what the fourth D is?
Oh, I'm going to pass it to Zach for this one.
Yeah, well, I think we know defer would be the answer, but I also want to hear about. I was thinking potentially death in an aspect of what happens future. Yeah,
that's exactly right. Defer, defer, defer. Never pay it while you live, and then die. And the reason for that is that under current law, there is a step up in basis that's given to your heirs. So all of this property that you have with tons of deferred tax. By the way, we do I've got a spreadsheet example we give to realtors when we're teaching our CE classes that shows how in 4 transactions, 2 investors, one of the only difference in the sales prices, appreciation, mortgages, and everything. One of them does the 1031 exchange, and at the end of 20 years, they owe $500,000 in tax. It's kind of a scary number, but they own $11.5 million of real estate. The other investor pays the tax as they go. So at the end of 20 years, they owe nothing. But they only own about $3.5 million of real estate. Why? Because that $500,000 went to buy more real estate for the investor who does 1031s. That's the compound interest effect, and that's huge. Now, when that investor dies, the first one, the property goes to his heirs, and they get their basis in those properties stepped up so that it's as if they paid market value on the day they died, which means that $500,000 in tax disappears. And that, my friend Adam, is how you never have to pay.
I love that. And it's so important because honestly, that's how you create generational wealth.
Absolutely.
There's a lot of different other investing asset classes and things you can participate in, which you potentially can't even pass to your heirs. And if you do, they're highly taxed on it, and it's highly regulated. And so I think, this is just goes hand in hand with why we're so passionate about real estate investing. the 1031 is just one of these beautiful things that allows economic stimulus and allows you to strategically grow your portfolio to achieve your financial goals over time. And you can couple this with other things. We won't go into this, but potentially doing cost segregation studies with accelerated depreciation. Rolling that into a 1031, coupling this with your other strategies is a creative way to really expand your portfolio. Let's use a real world example just with simplistic numbers, Dave, so we can help solidify this in the listener's mind. Let's say you have a property you bought for $100,000. You sell it 5 years later for $200,000.
Yeah.
And this is a rental property.
Mm-hmm.
So we're not talking about primary residence. And of course, if anyone has questions about your specific scenario, that's where Dave comes into play, where, we can help you strategize as well, but ultimately setting up a consultation with you is the best thing to go by case scenario and help people actually map out their plan. And so we'll include your contact information for people to reach out. But you have a property that you bought for $100,000. It's 5 years worth, $200,000. You go and sell that property. You have $100,000 of taxes that you potentially have to pay. And I will say one more thing: to hold a rental, usually it's all about deferring the capital gains. If you sell that property within 1 year, you build a property and sell it, or you buy it, renovate it, and sell it. Usually, that's not going to. And I know the IRS has a little bit of gray area in terms of time frame, but in general, you need to hold it a year and a day. That way, it goes into capital gains section, not active income. And that's when it makes sense to do a 1031, right, Dave?
Right, that's exactly right. Yeah, if your model is that you want to build and sell, or if your model is that you want to fix and flip, the IRS says that your primary intent there is to resell. And so a couple of things happen. Number one, that doesn't qualify for 1031 treatment, because 1031 properties are properties that you intend to hold. Number two, like you said, Zach, the tax bill is much higher when the hold period is less than a year. And number three, those two models are real work. And I don't know about you, but I'm trying to avoid work with this. I love real estate, but building, fixing, and flipping, compared to the joy of just watching a property grow and cashing the checks when they come in, I don't know. I've got a little bit of spoiled.
Yeah, and then you couple that with the tax advantages like what we're talking about today, and it becomes quite apparent that actually just buy and hold real estate over time can actually come out further ahead than an active flip. You get your quick nickel or long dime, as far as returns, and that's important to conceptualize. Is what is the long-term plan and how are you going to keep growing this? Because in theory, if you sell a property within 1 year, it's active income. You're taxed at the highest rate.
That's exactly
and you can't, there's minimal things you can do to shield yourself from those taxes. We all know that taxes is going to be the largest expense we're all going to pay through our life. And when you're talking about exponential growth, Dave, imagine taking that money and instead of paying it in taxes, going out and indefinitely deferring that and then using that to obtain a return and further your investing. That's where things get really exciting. So let's go back to our example: $100,000 house, sell it 5 years later, $200,000. You have $100,000 of potential exposure to capital gains. I don't have the chart in front of me, but capital gains from my memory is either 15 or 20% based on your income.
Yeah, plus your state. So you're probably looking at 20%.
Okay, so call it 20%. So on that $100,000 gain, because it's how much you subtract how much you sold versus how much you bought the property, and of course reduce like realtor commissions or anything like this. You're roughly, for round numbers, we'll say $20,000 of tax exposure, right?
Right.
So in theory, what you could do is do a 1031 to go out and take that and identify other properties to buy within the timelines that we're going to talk about, and then not have to pay any tax on the gains of that. And you can do this again and again on future properties.
Yeah.
Right?
Let's give people a chance to really put themselves into that picture. Let me back up one step and say, how did you get that $100,000 property? Because people don't realize this is how you slip into it. We're getting married as a society later and later, aren't we? And when that happens, we're always usually more ingrained in our careers. And we think we're on that corporate train, but we fall in love, we get married. She's got a house, he's got a house. Whose house do they move into? Hers, always, because it's the only one that's clean.
Yep.
They move into her house. What did they just become? Accidental investors. And 5 years goes by, And that's an awful lot of drinking the Kool-Aid of cash and rent checks. So you're absolutely right. We've got this $100,000 house. It's $200,000. Using the 1031 exchange, we can sell that property. And what does that $20,000 in tax represent? That's a down payment by itself on another $100,000 house. So you could buy, and this is a classic 1031 strategy. You can sell one property and buy several smaller properties. I think we had at least one guy with, and I think it was with your company, Zach, where he sold one property in California and bought 5 different smaller properties spread out around the country. It's called a Diversification Exchange. It's oh so powerful because it keeps your purchases at the range where you can maximize your ROI. You know, you may have a $100,000 property that you can get $1,000 a month in rent for. But a $200,000 property, you can only get $1,500 a month in rent because the demographics start to change. So which would you rather have? One $200,000 property getting $1,500 or two $100,000 properties getting $1,000 each?
And then in addition to that, to your point, you get to diversify. So you have multiple doors, likely potentially in other different locations. You now have 2 properties that have their own appreciation schedule, their own debt pay down, their own tax benefits. And I mean, scalability is the name of the game. And this is an essential piece of how you can creatively and strategically scale over time to build a portfolio to provide the passive income that you're trying to achieve. So,
right. And let me go back and give an olive branch now to the fix and flip crowd, because I get it. The adrenaline is there. It's oh so much fun. Here's how you can make fix and flip work with this. Because the other thing that selling a $200,000 property and buying multiple smaller properties is it gives you the chance to value add and force appreciation. And it keeps you in your comfort zone. See, I may have bought a $100,000 property. I understand what it takes to put a renter in. I understand what kind of countertops need to go in. I know what type of flooring is going to work. I know what neighborhoods to look at. But a $200,000 property, maybe that's a whole different demographic. Do I have to put corian or granite? Can I use laminate? Do I use real wood for the floors? What do I do? And if I don't know that, I can use the 1031, go buy multiple properties that are right in my sweet spot where I need to go. And here's where the fix and flipper can just kill it, because they like the adrenaline of fixing, but all you've got to do is, instead of flipping, rent it. Now, we met, I think, through the Bigger Pockets forums, I think years ago, didn't we? I'm pretty sure it was through Bigger Pockets.
mm-hmm.
You know, they popularized the whole BRRRR concept, right? Buy it, rehab it, rent it, and then refinance it. Well, that's a beautiful way to do it. Why can't a fix and flipper buy it, rehab it, rent it, and then refinance it, immediately take the refinance money and go buy their next property?
And the 1031 is still on the table for them in the
That's
future.
exactly right.
You know, as they grow that equity, you know, it's just, I mean, the more real estate you can keep over time is really what it's about. But we see this scenario all the time. Back to the California resident, not that California is just one of many states that's had crazy appreciation, but the cash flow really isn't there. And so someone could have a rental property that really is like break even or possibly negative cash flow, that they have significant equity in. And it depends on their goals, but usually it makes sense to go out and maybe sell that property and obtain a much higher return from cash flow on multiple properties in the Midwest, Southeast, whatever the case is. That's going to get you much further ahead as far as your overall return on investment and actually building up cash flow. It's good practice for anyone that's potentially considering this to look at some pro formas and run some numbers to say, if I sold this property, what kind of monthly cash flow could I achieve by buying more affordable real estate that has better cash flow numbers, and where is that going to put me 5 years down the road, and continually trading up from there? I mean, we also see, you addressed another point that I think is a common question we get, is about like properties. You know, you can 1031 from single family to multi, vice versa. You can do, go into different asset classes. Do you mind speaking about that briefly, Dave?
Yeah, as long as the property is being held for productive use and investment. So in real estate school, they teach you the four types are raw land, commercial, industrial, and residential. Those are all considered like kind because it's the use that really qualifies it. So sell single family, buy commercial. And again, these are key strategies for how to identify where to maximize your cash flow as you move through a market. Typically, commercial heats up slower. And so you can sell single families, move into commercial where it's going to be safer, maybe a recession edge and those kind of things, or move into raw land if you see growth coming and you want to get in the path of growth. Buy the raw land and sit and wait. That was, I think it was Will Rogers that said, don't wait to buy real estate and wait.
Can you talk a little bit about, I've had some people come to me and they hose themselves. They think, oh, I sold this property and now I'm going to do a 1031 exchange. When do people need to start having the conversation with an intermediary, and when is it just too late?
I got to give a shout out to Bob and Doug McKenzie right there. I have not heard the hose reference in decades. Nobody under 30 gets that at all, but I love it. Strange brew. I get these calls every month, Adam. There's absolutely nothing I can do except put a virtual shoulder around them and cry with them, because the qualified intermediary has to be in place prior to the closing of the sale. The reason for this is that there has to be certain documentation, part of the closing documents, and the client cannot touch the money. So if they receive a check, they've got actual receipt. If they tell the title company, simply keep the money for me, I'll tell you when I'm ready for it, that's constructive receipt because they control it. Both of those will invalidate your exchange. So I try to emphasize everywhere, and thank you for reinforcing that. Please, 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 you've got to get your QI in place before you close the sale.
So let's talk about some specific details that are important, milestones and requirements that people should be aware of and planning for. I mean, we have seen some people where they have they're already under contract. Their sale date is a couple of weeks out. Now, while it's chaos a little bit to do that, we have been able to, because we have properties that they can identify before they're closing and get the QI involved. I mean, that is something that is still achievable. It's not ideal, but it's all about that closing date. So you need to have, just to review what Dave said, you need to have your QI in place. You really should start planning for the 1031 before the sale of your property. But even if you have a property under contract, it's not all lost. We can, possibly go in and help you facilitate a 1031. You can even do a partial 1031, and we'll talk about that. But the ideal scenario is where you're planning in advance before you have your property listed for sale, so we can have enough time. Now, some other key concepts with the 1031 is the identification period and closing period. Let's go back to our example of that $100,000 house you sell for $200,000. You have $100,000 of potential exposure to taxes that you need to reallocate, and you need to have a complete 1031, use all of that money, right, Dave?
Right. There's a twofold requirement. You have to purchase at least as much as you sell, so roughly the 200,000. Secondly, you have to use all of the proceeds from that sale. So maybe you haven't paid any debt down, you still owed 100. You'd have $100,000 in cash that you need to buy $200,000 in real estate. That could be 20% down payments on $100,000 properties. That doesn't matter. As long as you purchase in aggregate at least as much as you sell, and use all the cash.
So you sold at $200,000. That means you need to identify and acquire at least $200,000 in new assets. Can be one, can be broken up.
Right.
And that those $100,000 of equity needs to be used as down payments or allocated to that acquisition. Correct?
Exactly. And actually, I'm going to jump into the 45 days in a second, but there's another really cool strategy that this brings up. Let's say that property was free and clear. You paid it off or whatever. So it's $200,000 in cash, and you have to go buy $200,000. You can allocate those proceeds in any way that you want. So one thing that I call defensive investing as you're moving into a later market where kind of there's some fear of uncertainty. When's it going to stop? Because every ride stops. When's it going to turn around? How bad's it going to be? Whatever. One of the things some of our clients will do is they'll use, say, 100,000 in cash and go buy a property free and clear. And then they'll use the other proceeds as down payments. As long as at the end of the day, they purchased as much as they sold and they used all the proceeds, they've deferred all tax. But what happened when they did that? They got one property that's now free and clear. It's out of harm's way. All you've got to do is pay the property taxes and the insurance, and you can adjust rent very easily to do that in case there's a downturn. But you also have other properties that you've got more leverage on. And leverage usually equals a greater return on investment. So you're able to actually make things safer and yet more productive at the same time.
I love it. So you have options. You just need to be aware of what those options are and incorporate the right people to help you put a strategy and plan in place. Let's talk about the identification and closing period. You have to identify the properties within 45 days of the sale of your property, and you need to close on all of those properties or the ones you've identified within 180 days of the closing of the sale of your property. Let's talk about that. And then also touching on, okay, if you do have leverage, let's say on that example of $100,000 property that you bought, let's say you owe $70,000 still on the loan. Does that come into play?
Right. So typically, the 180 days is not going to be too much of an issue. You find a property, you get under contract, 30, 60, 15-day closing, it's not uncommon at all. So that's not the issue, but the 45 days is the killer. That's the one that's the most scary, and that's the one that'll bite you the most. You do have 45 days from the date of your sale to identify, but as soon as day 45 passes, you can't change your list anymore. Now, you don't have to have the property under contract. It truly is just an identification in writing. But you guys, I mean, we all know if you've got properties you're looking at today and you're not under contract, next week, those are sold. They're not available because that's where we're at in the market. So you kind of want to think about that 45-day period as you've got to get your new properties under contract during that time.
You don't have to wait to identify for the sale of the property, right? You can identify beforehand.
And you can even go into contract ahead of time before your sale closes. As long as you close the sale first, and then we close the purchase second. So that's one great strategy right there. Sorry, Adam.
Yeah. Can you talk about the three different ways that you can do the 1031 with the three properties, the 200% and the 95%?
Oh, we've got viewers in need of a nap, do we?
We're getting deep into it.
On a very broad level.
Well, so here's the deal. If you're trying to buy a property that is at least as expensive as what you're selling, like you're selling for 200, you want to buy for 200, or you're wanting to leverage that, say into a large commercial property, you have to keep your list to 3 or fewer. And the reason for that is if you name 3 or fewer properties, then their value doesn't matter. But as soon as you want to name 4 properties, like selling for 200,000, you want to buy 1 for cash and 5 with down payments. Their total value cannot be more than 200% of the value of what you sold. So your entire list could not be more than $400,000. See how that becomes a little problematic, right? The one exception to that is that if you close on 95% of the value, in other words, if you went into contract on all 5 of those prior to the closing of the sale and closed on them during the 45-day period, by default, that's your list, and you purchased all of them, and so that would count.
Let's just review that because that's a lot of details.
Yeah.
If once you identify more than 3 properties, you fall into this category, right? If you're identifying
the 200% rule, right?
Yep. So you can identify as many as you want, but once you identify over 200% of the value of the property that you sold, you pretty much have to close on all of those properties, is what it boils down to.
Either their value has to be no more than 200% of what you sold, or you have to close basically on all the properties.
So three properties or under, that doesn't even apply. Once you're 3 or 4 properties or more, you need to be conscious of the total amount that you're buying, which we actually see this often, just because they have a lot of equity and they are using leverage to really scale, which is great. They just need to be very conscious. And this is where our team works with them hand in hand to say, all right, if you're identifying these properties, we got to close on all of them, because that means, and you still got to go through due diligence. Ideally, in a scenario, the best case scenario, if you are exceeding the 200% rule, it's best, in my opinion, to do this. And this is why planning is so important, to actually get through your due diligence, your appraisal and inspections prior to that identification period being up. That way you still can make changes if you need to. If you have an appraisal issue in your post identification period and you are above that 200% rule, you still got to close that property, because you don't want to interfere, because that can turn your 1031 upside down.
Yeah, you're toast.
And then you still are under contract. So, I mean, ideally, we try to keep it under that 200% rule. In some cases, it absolutely makes sense to do that if that aligns with the person's goals. It just takes closer attention in monitoring. So,
right. And one of the things that's become like a go-to strategy for me, for my clients at this time in the market, is to say, we sit down let's just take a look. What's the hardest job in front of you right now? Is it selling the property? No. It's buying a property. We're all experiencing it. Multiple offers, just till you get one, right? So take care of the hardest job first. Get a new property under contract. Identify the properties you're working on. Start working forward on them as much as you can. Then list and sell your old properties. I'm seeing in many markets literally 15 and 20-day cash closes. Well, that's pretty easy to make that work with your 1031.
I'll say one perspective from our end and on the seller side is sometimes we push back on that a little bit if financing is involved, because of course you can't have a property sitting under contract for 6 months. I mean, it's just not advantageous for people. So you have to make sure that if you are putting properties under contract before you sell your property, that your sale is pretty much a sure thing, and that it's going to go through rather quickly, because no seller is going to want their property just to sit out there under contract for 2, 3, 4 months while they're having they may have plans for their money. They may be wanting to do a 1031. You don't know. So, I mean, there's a little bit of a balance here, but absolutely what you said is appropriate, Dave, of doing what you can now and just speaking with the right people and creating the plan, versus trying to wing it in the final hour, which we've done and is okay. But I mean, the planning is key. We missed over one point that I wanted to discuss previously. Just talk about leverage real quick. Is there a leverage requirement based on the leverage you have in place? Where does that come into play?
No, there is not. The two-part, it's a common misconception that you have to carry the same amount of debt. You don't. All you have to do is follow that two-part rule of purchase at least as much as you sell and use all the cash proceeds. You'll defer all tax. Now, in the example that we were using, there was, I think you said 130 in debt. So they had 70,000 in cash. So you sold for 200,000. You have 70,000 in cash. You have to use that 70,000 to go buy at least 200,000. The reason why this misconception has come into place is because a lot of people, most people, don't have access to $130,000 in cash. So they think, I've got to replace the mortgage. You don't have to. You could bring your own cash in. You could bring in cash from another source. Remember, we've always got access to HELOCs, secondary letters of credit, retirement accounts we can borrow from, whatever it is. You don't have to replace the debt specifically with the mortgage. You just kind of play with those jigsaw puzzles and see what's going to work.
So debt could be irrelevant. Usually debt's going to be factored in because it allows you to scale and buy more.
Here's one great tip that I totally forgot about, but when we were talking about the idea of taking care of the hard job first, and you said not a lot of people are going to want to have their properties sit out there under contract. And why is that? Because they want to sell, they want to buy now because those properties are appreciating every month, right? What if, as the seller, you use that to your advantage? You want to sell the property and get it under contract, but you also want to be able to find your new properties. There is a ton of buyers, I'm one of them, by the way, who would love to get a property under contract today with a 120-day close. Because why? I've locked in a bunch of appreciation, haven't I? And I know who's going to be buy it. And so they can then go and shop for their 1031 replacement. So you can think like the opposite side and make that to your advantage. Did I say that in a way that made sense?
Yeah, I think so.
Yeah, I think that because it is important to understand what both sides of it and see how it makes sense. Traditionally, what we're seeing right now in like the turnkey side and really to real estate across the country, just with the type of market we're experiencing, is people are selling, properties are selling very quickly. And so it is important to get them under contract, and you need to have a reasonable time frame to be able to close on that property. Yeah. But there are things.
Here's another question for you, Zach. In your experience, let's take the turnkey thing to stage 2, right? So we bought a bunch through you, and now it's time for me to sell those. Are you seeing a fairly high percentage that are being sold to the tenant?
Not typically, but okay. I mean, that is something to be conscious of. If you have a tenant that could qualify and afford that, and you want to go down that route, I mean, that is an option. People have been blessed in this market that, hey, they just buy a property at market value today, and shoot, a year or two later, you could have significant appreciation. Right. Where doing a 1031 does make sense to any buyer. But we don't see a lot of it, Dave. I think that's something that's the more savvy investor could help, I guess, conceptualize a little bit better. However, in a potential down market, I think that's a very viable option as well.
Well, one of the things we know is that the government, in order to equal things out, they offer incentives, and incentives is money, right? So we will see over the next few years, as rents are going through the roof, and as we become a nation of renters, the federal government's always going to try to bring it back into equilibrium. So I think at some point in time, we're going to see more incentives for home ownership. And that's when landlords are going to make a heyday because the tenants want to buy, the tenants are qualified, and they'll be able to. So yeah, I think that's something to look for in the future.
Well,
Absolutely.
that's beautiful that you said that, and I want to just reiterate that for the audience, because so many people are potentially we get the question a lot. Well, what about the market? Is it going to crash sometime? Well, what about the future? Is my property going to lose value? Again, we go back to the fundamentals of, as long as you're investing for cash flow, it's kind of that point in time is irrelevant in terms of what that property is worth. All real estate goes up over time, and you just have to time your selling. But if you're investing for cash flow, your return's still going to be the same. But that is something to be conscious of, hey, in the future, if you own property right now, and that could be a potential exit strategy, and you could be incentivized to do that as you have this new buying group available to actually take over home ownership and make it more accessible to them. So there's always things to be I mean, if you're buying fundamentally for cash flow, it shouldn't matter anyways, but there's always going to be different legislative changes to incentivize people for taking action, just like we talked about in the beginning. So thank you for mentioning that point.
Yeah. So Dave, is there a certain amount of equity that someone should have in a deal to make it make sense to do a 1031? Is there a level that it's kind of like, why bother?
Well, there's a straight up math equation, right? A 1031 exchange my favorite exchange of all time. Back in the day, we were charging $750, and the lady was selling a property that her tax was going to be like $1,200. And you're selling a $12,000 lot, I think. And I said, are you sure you want to do this? You're paying $750. You're not saving much. You're saving $500. And she said, but Dave, that's my $500. I went, heck yeah, go for it. So yeah, there's a math equation that says this is no longer worth it. But other than that, it's really a function of what else is going on. Is it going to be, do I already have a property lined up? Well, if it makes sense and I save $10, hey, $10 is $10, right? That's the kind of thing. Or it might be where you're thinking that, I mean, I've had clients not do exchanges where the tax was a couple $100,000, but they chose not to do it because the timing wasn't right. So I think really it's factors other than the economics of the exchange that have to go into it. You've got to look at your picture and say, given where I'm trying to get to, does a 1031 exchange right now take me closer? And if it does, you do it. And if it doesn't, you wait.
And here's one thing I always tell people is why everyone should at least explore the idea of a 1031. One, it's just part of being a savvy investor and knowing what your options are and looking at the actual tax picture. It's always important to run those numbers. But what's the worst case scenario? I mean, if you don't go through, let's say you go through the 1031 scenario and your 1031 fails, or you just don't, you don't complete the 1031, assuming you haven't bought any properties, you're not into this 200% rule, et cetera. But I mean, you're really back to square one. If you're planning to sell the property anyways, you might as well explore it and look into it. Sure. Because the downside is if you don't go down through the 1031 route, you're just back to just normally selling a property, right?
If you don't do the 1031, you're going to pay the tax. If you start the 1031 and don't complete it, you're simply going to pay the tax. So what do you have at risk? $1,000 exchange fee? And this is kind of fun because I love data. I'm data driven, and we do internal audits all the time. And even at this point in the market, this surprises people because there's this fear. I can't find good properties, right? Everybody's got the fear. But what we've actually seen is that even right now, over 90% of our clients that start exchanges are able to complete them with properties that they're happy with. So, come on, Adam, I'm selling lottery tickets and I'm selling them for $1,000 a piece. But there's a 90% chance that you will get a winning ticket for $60,000. How many are you going to buy?
All of them.
Quite a few. Yeah. Many as I can afford. As long as they don't go over 200%, right?
I'm going to do a quick plug for why it's important to be working with Rent to Retirement or someone that is a viable seller, because this is also an important thing for people to understand. On the sales side, you need to work with sellers that are cooperating to meet your goals as well. Everyone's goal is to sell the real estate, and for their goal is to, the person going through the 1031, their goal is to initially sell and then to buy more real estate. So everyone's working towards this common goal. But if you're trying to do an exchange where you have multiple sellers involved and not kind of organized with someone overseeing this, I mean, it could take, especially if you are over that 200% rule and you have one seller that decides not to perform, or something goes wrong where they can't negotiate to get that deal done and they don't care about your 1031, that could turn things into a bad situation. So it is important that when you're looking for successfully completing a 1031, that you're working with people that you are confident are going to assist you with identifying properties that meet your criteria, and also working diligently to accomplish your goal on all sides of the transaction where the seller is willing to participate and you have confidence that those sales are actually going to go through, because that's something we don't really talk about. But one seller could potentially mess up your 1031 even when you do everything appropriately. So that's why working with our team, we have confidence that, yes, we're going to get across that finish line in a timely manner that you need to accomplish your 1031. I mean, do you agree with that, Dave, or what are your thoughts from your side?
Oh my gosh, wholeheartedly. Because the world is a much smaller place. We all get it. The internet makes it easy. I can look at Zillow and see inaccurate values for houses all over the country. But having one point of contact is so key. If I'm trying to buy properties in the Midwest and in the South and in the Ohio Valley, I don't want to have to work with all kinds of realtors. I'd rather work with one person who already is working with all those realtors, because that streamlines things. And I know the thing that we've seen a couple of times is that something may go south. Something may go wrong with a purchase in the South. But because you're controlling a number of and have an interest in a number of different markets, it's a very quick and seamless process to say, let's pivot. Cincinnati's just as good. Oklahoma City's going to do well for you. And we've got this available now. So you don't have to lose the exchange because there's a hiccup right in the middle. Yeah, it's key. We all like the idea of being broader focused, but the exchanges I see fail are those where people are not focused with lasers on their replacements right from the get-go, or those that try to have too many options. And you eliminate that by having one point of contact who's coordinating it all. Yeah.
Perfect. I think we're going to leave it there. We don't want to go too long today. We will have more episodes about 1031s in the future where we'll dive a little bit more into these. But Dave, really appreciate you spending time with us today. Dave, again, is a 1031 specialist and qualified intermediary and founder of the 1031 Investor. You can find more information about him on our website at renttoretirement.com. Click on the About section and you will meet the team. And Dave is one of the team members we have up there, and you can get in touch with them that way. If you have any questions for us or anything you want us to ask Dave on the next go around, you can email him to podcast@renttoretirement.com. That's podcast@renttoretirement.com. You can see all of our inventory on the website or schedule a call with us. We can talk with you about properties, about setting up a 1031 investment plan. If you're looking to get into a 1031 soon, kind of schedule, make sure that your values are good, make sure you're using up all the money that you need to use. Again, that's renttoretirement.com. Really appreciate you joining us for today's episode. We'll see you on the next one.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.